the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements for today. While Singapore shares dipped as investors continue to mull the US Federal Reserve's latest move to hold interest rates at prevailing levels. So the Straits Times Index was down 0.31% at 3,908 points at about 11:50 a.m. Singapore time, and that is with a value turnover of some 350 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI closed down 0.68% at 3,894 points. In terms of value turnover, we are looking at 933 million Sing dollars. The gainers trailed losers 167 versus 315. Top advances for today, we've got for you Spindex Industries, GMHUSD and Hotel Royal, and top decliners, we've got for you DBS, ASUS and Shangri-La Hong Kong dollars. Well, in terms of companies to watch, we have DBS because the lender inked an MOU with the Australian Trade and Investment Commission today to deepen investment links between Australia and Southeast Asia. Now, elsewhere from the Fed's dot plot of future rates and the central bank chief Jerome Powell's comments on US tariffs to Shell CEO's take on the escalating conflict between Israel and Iran, we've got more international and corporate headlines in focus. And joining me on the line on a Thursday is David Chow, director at Azure Capital. David, how are you?
Hi, Tian Tian. I'm fine. Hi, everybody. Hope everyone is doing fine.
Yeah, and let's start with the U.S. this time around because the U.S. Federal Reserve held interest rates steady for the fourth straight time as expected. Now, more notably, Fed Chair Jerome Powell said goods price inflation will pick up over the course of the summer as President Donald Trump's tariffs work their way to U.S. consumers, who he argued would bear some of the costs. Now, policymakers still, they projected 2 quarter-point rate cuts this year, a slower pace of future easing. What do you make of the latest decision, and how did investors react to the news?
Prior to the meeting, the market had fully priced in a decision, to that effect will keep interest rates on hold. So the unchanged outcome is far from being eventful. Despite, I think, recent economic data offering no more justification for a rate cut, Powell has leaned on the possibility of higher inflation down the road. So, the Fed, decided to remain on the sidelines for now. So, as such, I think the market will continue to play the guessing game, especially on the situation surrounding the Middle East. While there were also some, less hawkish comments from Trump, which weighed on oil, but the broader market moves were locked up in anticipation of the FOMC. And so, the decision of holding rates, FOMC statement, and the dot plot, didn't move the market much. Mm-hmm. The dot plot, in fact, remain at 2 cuts this year, as growth expectations have come down, but inflation has sort of moved up, and I guess the market is going to quickly shift back to the trade war and the Middle Eastern conflict as market drivers now, which is basically a guessing game of what Trump will do next. With all these, the Asian markets today sway to the risk-off mode.
Okay, and going back to the Singapore stock market as usual, David, how far did the STI track regional movements today? I mean, if we look at Hong Kong down, I think 2%. Any surprises when it comes down to the biggest movers and the sectors that they lie in as well?
Right. I think STI was down 0.7% at the close, in line with the negative mood prevailing in the Asian markets. But I think the fall was more compared to the other markets, and especially to the proxy of the Asian region, which is the MSCI APEX 50, which I think fell close to 1.68%. So even though the STI index was down and the Fed didn't initiate a cut this morning, some of the REITs like ESI, Member 3 Industrial Trust, they actually edged higher. So I guess there could be some sort of a sector rotation at play here. Other than that, things were pretty much normal.
Okay. And zooming in on some of the companies to watch, David, we've got 2 banks in focus today, DBS and UOB. So let's start with DBS. Now, DBS inked an agreement with Australian Trade and Investment Commission today to deepen investment links between Australia and Southeast Asia. How would you read into the news, and how significant is this for DBS looking at its share price movements today?
Yeah, fortunately, the index was down, and in times like this, it's hard for, the big index component stocks like DBS to deviate from the broader market. However, this move by DBS is definitely share price accretive in the medium to long term. In our own, preliminary assessment, we think that this initiative could support, DBS's low to mid single-digit revenue growth, with increased lending and possible corporate deal fees from Australia, and that could also help to offset pressure from your prospects of possibly up to 4 rate cuts before the end of 2026. And the deal, which will also help to support local businesses Australian local businesses expand into Southeast Asia, and reflects, I think, the region's potential stronger supply chain hub status in the new trade war environment. I think lastly, there's also scope for DBS to tap into Australian pension fund industry, which could also strengthen their own wealth management fee income, which I think increased by 30+% in the first Q of 25 this year. So I guess for now we wait for updates to see how soon can this partnership be kickstarted.
I see. From DBS, let's go to UOB, David, because UOB and UOB China, they have become direct participants in China's cross-border interbank payment system, which is this wholesale payment system authorized by the People's Bank of China that facilitates the settlement of trading and investments in renminbi. What does the move mean for UOB? And again, how did investors react to the news today?
I guess with this move, a direct participation in CIPS will actually allow, I think, UOB to independently process, clear and settle, cross-border renminbi transactions without relying on intermediary banks. So, as such, this actually streamlines operations and cut transaction costs, which is a huge plus to end customers. And in our own RMB transaction tracker, we can actually see it doubling between in the last few years. So, direct CIPS access, will position you capture growing demand for renminbi-based trade investments, especially in the China-ASEAN corridor. And this would also enhance UOB competitiveness against local peers. So now UOB can offer perhaps tailored solutions to clients, including corporates and financial institutions, which will go a long way to boost its transaction banking revenue, which grew, I think, 30+% in the last couple of years. So similar to the DBS, UOB share price was down today, as the prevailing sentiment took over.
Okay, now if you're just tuning in, we're now in conversation with David Chow, director at Azure Capital. Well, David, let's stay in Singapore. Dozens of staff at Stanchart have reportedly been laid off in Singapore in a fresh round of job cuts by the London-based bank. And according to finance jobs portal eFinancial Careers, the move affected about 80 Singapore-based employees understood to be from the bank's tech and operations teams, with their jobs being offshored to India. Now, when contacted by ST, our colleagues at ST, a Stanchart spokesperson said Singapore remains a critical center for their global businesses and technology and operations teams. He did not provide details as to whether the job cuts are part of the bank's plans to save costs to return more capital to the shareholders. Any thoughts on that?
Our thought is that for Stanchart statement to the Straits Times, it actually reflected a strategic emphasis on Singapore as a key hub for its global operations, particularly in tech and operations. But the lack of details about job cuts suggests a cautious approach to public communication, possibly to avoid signaling distress or to manage stakeholders' perceptions. And if the job cuts are part of a broader cost-saving initiatives as speculated, it aligns with common banking strategies that we have seen, to streamline operations, to boost shareholder returns, especially in a higher cost environment, like Singapore. However, without specifics, it's unclear if these cuts, target redundant roles, automation-driven efficiencies, or simply a shift in business priorities. And as I've said, the banking sector often faces pressure to optimize costs while maintaining growth. And the Stanchart focus on tech and ops in Singapore indicates they're sort of doubling down on high-value functions here. So job cuts, if confirmed, could actually reflect a pivot towards automation or outsourcing lower value tasks elsewhere.
Okay. Now, further away, David, Shell's CEO said today that the oil and gas major was being very careful, quote-unquote, very careful, with its shipping through the Middle East given the escalating conflict between Israel and Iran. Now, as we know, as we're speaking, the Iran-Israel air war entered a 7th day today, with U.S. President Donald Trump keeping the world guessing, as you alluded to at the start of this interview, as to whether the U.S. will join in the fighting. So what would an escalation in the conflict and perhaps the involvement of the U.S. mean for oil majors like Shell in terms of supply chain disruptions and in terms of oil prices?
If we see, one of the most used shipping routes in this area of conflict, I think it's the Straits of Hormuz. It's a critical choke point for about 20% of global oil and 20% of your liquefied natural gas or LNG trade. It's a risk of disruption if of course Iran retaliates by targeting these routes. So any interference such as blockages or attacks could possibly increase your shipping insurance costs, delay, which will lead to a delay of deliveries, and really strain global supply chain. And one other thing we will have to consider is risk of regional energy infrastructure damage. So when we see Israeli strikes have already hit Iranians' energy facilities, including their South Pass gas field and I think refineries. And while Iran's attack damaged Israel's Bazan oil refinery, further escalation targeting oil fields, refineries, or even export terminals, could actually stop production and exports. And this will, of course, force Shell to seek alternate supplies or face shortages. And we are also talking about possibly shipping and navigation risks with electronic interferences with ship navigation systems, which has surged around all these troubled shipping routes. This will somewhat complicate maritime operations. So there's definitely a lot to watch out for. And of course, with all this, oil prices could potentially spike to $100 to $120 in the short term. And even though higher prices could boost Shell's revenue, but it complicates their refining and consumer markets.
Okay. And finally, before we let you go, David, let's talk about Apple, because Apple's SVP of Hardware Technologies reportedly said in private remarks last month that Apple is interested in tapping Gen AI to speed up the design of custom chips that are said to be at the heart of its devices. How far could this reignite interest and excitement among Apple investors?
Well, I guess the CEO's emphasis on AI as a huge productivity boost is sending a signal of Apple's intent to maintain leadership in hardware innovation, and this could appeal to investors which focus on long-term tech dominance. And I think furthermore, the involvement of electronic design automation giants like your Cadence Design Systems, which actually integrate AI into their tools, underscore the feasibility of this approach, lending credibility to Apple's strategy. And if you take a step back, this could also help to counter recent investors' disappointment over Apple's slower progress in AI, compared to its rivals like OpenAI, Google, and Meta. But however, I think there's some limiting factors that we have to be mindful of. In the sense that Apple's AI efforts, in particular Apple Intelligence, have faced scrutiny for slow progress, limited features, and reliance on external partners. So I think repeatedly, we have told our investors that Apple needs significant AI advancements within the next perhaps 6 to 12 months to really satisfy investors, which suggests that chip design improvement alone may not be enough.
Okay, I suppose there'll be lots to watch. As usual, thanks so much for the insights today, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.